Welcome to The Real Money Show, the number 18778 Silver, and the website guildhallwealth.com. If you've been watching the markets, seeing inflation run wild, you're probably thinking, maybe I should get into some of this physical gold and silver. Well, we're going to give you some reasons why, and we're going to show you how to do it on today's show. Some of the topics we're going to discuss is going to be, we'll touch base on the Fed, look at some technical forecasting in the market on the precious metals. Let's take a look at the physical market as it is, shortages, demand, what kind of wait times are we looking at, what kind of products are available. We'll touch on inflation and a new term that's making the rounds, demand destruction. But first, Jerry, welcome to the show. Jerry Correia, how you doing?
Good, Jeremy. How you doing?
I'm
good to be back on the show.
I'm good. I want to do kind of a spitball here on Russia and gold.
Yeah, let's do it.
How do you feel about that?
I'm all right for the spitballs.
Okay, let's connect some dots. We want to talk about Russia and gold. Let's start with, I've got a few article headlines, and you know what's interesting, Jerry? Now more than ever, I find myself reading between the lines. I don't know about you, but
we have to.
Let's look at the first big one, okay? This comes from CNBC. BlackRock's Larry Fink, who oversees $10 trillion, says the Russia-Ukraine war is ending globalization. That's a big thing to say.
Big statement.
That's a big statement. He's saying that, quote, the Russian invasion of Ukraine has put an end to the globalization we have experienced over the last 3 decades. Basically saying that Russia and Ukraine upended the world order that had been in place since the Cold War. That's huge.
Yeah.
That's huge because now just kind of hold on to that. Hold on to that idea of what's happening in Ukraine right now is signaling the end of globalization. Of course, this bank has taken advantage of that, and it's been kind of their bread and butter, the whole globalization. But let's just look at some other things that are happening. Do you remember, Jerry, a couple weeks ago on the show, we talked about the Stop the Russian Gold Act. That was a bill being introduced. And also that the London Bullion Market Association decided to remove several Russian gold refiners from the good delivery bar list, right? And the funny thing about that was they said that, well, if we already own the gold, it's fine, right? It's as of tomorrow, whatever we're going to take in is not going to work anymore. But in light of some other information coming out, and we'll dig into these. Here's another headline. This came from Zero Hedge. IMF warns countries may cut dollar reserves in response to U.S. sanctions against Russia. So you have these sanctions against Russia. They're even on the gold side. We don't want your gold. We don't want your money. You can't use the U.S. dollar. You can't use the SWIFT system. And it does seem as though Russia was prepared for this. They seem like they're okay with this because they support so much of the world's food market through fertilizer and propane, as we've come to understand very quickly, and of course gas. And they continue to deliver on all of their contracts.
Yeah, that's right.
But people are going to have to pay countries are going to have to pay increasingly more money as their dollar falters. And since Russia's being cut off from all of these systems, they have to say, okay, fine, we'll just take rubles or just take gold. So what's your perspective on Russia? We'll jump before we kind of go into some details. What's your perspective on gold backing its ruble? Just coming out and say, that's it, we're backing by the gold.
That's right. Huge moves from Russia. And we kind of saw this years ago in U.S. dollar dominance kind of losing control, which is why we're seeing a birth of other monetary systems and the birth of Bitcoin, etc. So there's always been a move away, and I think Russia has shown that they have that they've pivoted, but they've been prepared for this a time like this. It seems like the U.S. dollar hegemony is coming to an end, particularly with the petrodollar system coming to an end. That was the staple for the U.S. dollar. Without the petro petrodollar system, oil being traded in U.S. dollars, and we're seeing simply, Putin said, unfriendly countries will have to pay us in rubles for the product that they want, and it's a simple move to boost up the ruble. We saw a reaction to the Russian stock market on the positive side, the positive ruble side, but this situation is far from over. But we're seeing it's an easy pivot. They were prepared, and because they have the resources, they have the oil, they have the fertilizer, they have the gas, and above all, they have the gold. So they can make the rules. They can pivot and create a new system, and it seems like the system is already in place. I think they've had it under control for a long time.
The number 18778-SILVER, the website guildhallwealth.com. Jerry, you don't surprise me. You already seem very well educated on this subject, because I just saw in this article about the IMF warning countries will respond to the sanctions, saying that Goldman Sachs released a note warning that the twilight of the U.S. dollar's global hegemony could be at hand. Wow. Did you read this article?
I did not, no.
No, these are just your own thoughts. You match that of Goldman Sachs.
Well, I think everyone is sort of...
But you didn't go to Rutgers.
I didn't go to Rutgers. Okay. No, not at all. Everyone's repeating, and they see that the writing is on the wall, and it's, it comes to a point where the mainstream news has to kind of reveal the truth in the news for once. They're talking about the U.S. dollar. They're talking about, well, the sanctions just don't work. They thought that the sanctions would work, but they're not working.
Yeah, there's something kind of shooting yourself in the foot, or if I can create a new word, boomerangy, about these sanctions in any capacity. Take for example, not accepting Russian gold, or taking certain refiners off the good delivery bar list. Okay, so what you're basically saying is, unlike a country that might put capital controls and say, because this has happened many times in history, you go, we're not allowing you to export gold or silver out of the country. We need it in the country to keep the currency afloat. We don't want it getting into other countries and fleeing. Right? Mm-hmm. So that's happened in the past. But instead of Russia doing that, they're being told they can't move the product out of the country, essentially, meaning, great, they can put it into their central bank, continue to accumulate it. And I was listening to a podcast where they were talking about that the central bank of Russia isn't putting any pressure on the retail market in Russia. They're letting the banks keep their gold to supply the retail market. That's or right. The Russian people who are running to the exits to make sure that they've got something hedged in their hands, hedged against any potential collapses, I guess, against the ruble or whatever is happening, inflation, et cetera. But I thought this was kind of interesting, Jerry. This headline of IMF warns countries may cut dollar reserves in response to U.S. sanctions against Russia. So this came from IMF's first deputy managing director, Geeta Gopinath, and she's quoted with saying, "We are likely to see some countries reconsidering how much they hold of certain currencies in their reserves." And she's basically talking about the fact that psychologically there's going to be certain countries that are going to say, well, if you can stop other countries from using their currencies, what's to say you can't stop our country from doing the same, right? Like, in other words, Russia's got currencies all around the world, but they're being blocked off from Russia. It's making people think about, or countries think about, well, how dependent do we want to be on these currencies? And that got me thinking, that sounds very familiar with the government overreach we experienced recently. When the government seizes assets from someone who donated, right, to a cause, there's many people that are thinking, well, if they can do it to them, they can do it to me. Maybe I don't want to be part of that. Maybe I should protect myself against that. Yeah, because you've already done it.
Because there could be many more causes. There was just one cause. There could be others. Other causes that we may want to support. And if it's our money, we have the right. If we're doing it the legal way, if it's a just thing, if it is in line with the charter and the rule of law, then we should have the right to fund any cause that we so choose. But again, we have to think twice now with the government and their sights on our bank accounts. So they showed their hand, and I think Canadians they're out of the bag. I mean, this is the jack in box. You can't put the jack back in the box.
And this is not just on a personal level, but obviously if you're talking about IMF, this is now a global level with central banks saying, well, maybe we shouldn't have my money in your bank just in case you decide to hold it off from us because we take the wrong side or whatever, we end up on the wrong side, or you just make this decision. So it's scaring people when you take these sorts of actions. Before we go to break, let's just end this conversation of gold backing with this. James Turk, amazing gold analyst. I'm still working my way through his new book. This is through King World News, an eye-opening chart. To return to a gold standard and its historic metrics, the gold price would need to be $30,000 an ounce. It just shows how big the everything bubble has been inflated by central banks conjuring up purchasing power from thin air with fake money. So just before break, Jerry, we said that according to James Turk, the ante has been raised. It's now no longer $10,000 to get back to a gold standard. You would need gold to go to $30,000. And for him, that represents more about the everything bubble rather than what gold actually represents. Right. It's just saying this much money, this much fiat currency has been concocted out of thin air. And over break, we just did the calculation on a 15-to-1 ratio of what that would look like to gold.
So referencing the silver to gold ratio, gold at $30,000 at a 15-to-1 silver to gold ratio would put silver at $4,500 US per ounce, Jeremy.
That's a whopper. Hold on. So if you have 1,000 ounces, which today is costing a little over $30,000, you'd have $4.5 million.
And this is the standard that needs to have happen. If we need to bring back trust into a system that has lost total credibility, and you just mentioned just currencies out of thin air, we're not talking about the quadrillions of toxic derivatives that also need to be backed up. So this is something that BlackRock knows all about. They have tremendous exposure in the derivatives market, and I believe that they're getting ready for a wild ride.
There's almost an arrogance in that sense sometimes. If you can't believe that gold can go up that high, you also would have to believe that the derivative market can't fall. Now that's kind of interesting because in 2008, the central banks did back up the market by just printing quantitative easing and taking the balance sheet on the Fed from under $1 trillion to over $3 trillion, not including where they put out to everywhere else and all the other banks that they bailed out and therefore moving forward were on the same side of colluding with them, right? Mm-hmm. And I don't think that that's controversial to say. They all raise rates at the same time. They all lower rates at the same time. That's colluding, right? But I don't think that we're in a situation where a bailout can happen now because the derivatives are worse. The money's already been printed.
That's right.
Whereas at some point the credibility runs dry, and I think we're getting very close to the tipping point, especially when food prices are rising and energy prices are rising. Well, how on a scale of 1 to 10, how backed into a corner do you think the Fed actually is?
I mean, they have no other play in their playbook. They have exhausted, as you mentioned, all of the tools in their toolbox. Quantitative easing 1, 2, 3, Operation Twist, yield curve controls possibly coming, but the yield, if we look at the 30-year U.S. bond yield chart, it's basically showing that this chart pretty much topped out for the 30-year, and as yields fall on the realization that there is a recession coming up or financial markets are crashing, gold will react as they always do. Gold looks very, very positive at this point, but this is an indication that the Fed is cornered. They have lost all credibility, and we have to watch what they're going to be doing. Now, they spoke a couple times this past week. We saw a couple Fed committee members openly contemplating a 50 basis point rise in the cards. And we have to remember the last Fed meeting, they did raise rates, quarter point, big deal. But that didn't do anything. That actually causes inflation to take off on you. As you try to raise rates, if you're not going to be doing it aggressively, inflation just takes off and hurtles away like a deer. And now they're saying, well, we got to go with 50 basis points rise, that it's in the cards. The market is now pricing in 8 rate hikes this year and 50 basis point hikes both in May and June. Now we have to remember the last time that they raised 50 basis points was the year 2000, and that popped the dot-com bubble. So a lot of people are coming out fearful. Carl Icahn, even Raoul Pal from macro insiders, all citing a hard landing ahead. Not a soft landing as the Fed would want to say. They're actually saying, there's no other means by which we can get out of this. It's going to be rate hikes all the way, which will ultimately end up in a recession or a market crash.
And what's also interesting, Jerry, is the Fed's balance sheet is just reached an all-time high. So even while they've been talking about raising rates and actually raising rates, they're still printing money. They're still adding to their balance sheet. They're still buying bonds. They're still the buyer of last resort. So they're talking out of both sides of their mouth on that. Mm-hmm. Let's build a picture of what this is actually going to look like, of what it could look like in terms of if you just take what you see around you now, okay, high inflation, higher energy, higher food. Just think about let's just play this out and see where it heads. So now, and Biden has basically come out and said there's going to be food shortages, right? Because again, they refuse to go back to producing their own oil. So they're still going to import it, which means it's still going to be that much more expensive. Everything's going to be more expensive. Now, as prices rise, I heard that Uber is adding a surcharge. So rather than just raising their prices because of gas, they're just going to add a surcharge. I know that that's happening in the car industry too. It's just, we're going to keep the sticker price the same. We're just going to add surcharges.
Premiums.
It's not much different than in the gold and silver market. The paper market is broken. Mm-hmm. It's broken. That price doesn't exist anymore. Nickel proved it that those paper markets are broken, and now there's a physical market that says, that paper price doesn't exist. There's going to be premium upon premium,
right?
So that's just going to keep going and going, and eventually you're going to get to a point where people have to make decisions because their income isn't keeping up with that. So they have to decide between going out for dinner or buying some clothes or paying a parking ticket. Right? Mm-hmm. So now you've got demand destruction, which means we're headed straight towards a major recession where prices could still continue to rise because whatever is available is more expensive.
Yeah.
Right? There's not as much on the shelf, but if you can find it, you're going to have to pay for that.
Yeah, that's right.
Are we on the same page with that?
Yeah.
What else do you see happening?
Well, yeah, the prices are, as we're seeing in the U.S., the prices are moving up at the fastest pace in 40 years. At a point where there's still product on the shelves. There's still items that you can shop for. It's still available. There comes a point, and we always bring back Venezuela, and it's funny that the U.S. has started to trade oil again with Venezuela. So they
got desperate enough.
They got desperate. So they opened up the taps.
Make an enemy, make a friend.
Exactly.
That's what they did.
Exactly.
They said, Russia's the enemy. Now we'll go back to an old enemy and make them our friend.
100%. And we knew that was coming, but in Venezuela, we had seen before that. I mean, this is one of the wealthiest nations in the southern hemisphere. Now poverty-stricken. The currency has collapsed. But we remember how quickly prices doubled in Venezuela. And when that happens, you have the panic where people are literally trying to spend their cash on anything to preserve the store of value, to preserve their purchasing power, whether it be gold, whether it be a stapler.
Yeah, we've heard
anything.
We've heard that story lots of times from Eastern European clients of ours, saying, we in Czechoslovakia or Hungary, Poland, where they said, no, we had to spend our paycheck like as soon as we got it because otherwise we wouldn't have the purchasing power. I know they did that in Argentina. They had hyperinflation pretty recently in the last, I think 5-6 years. So it can definitely happen. But look, I mean, even look at how that's going to converge with the real estate market. landlords are asking a lot for rent. If you have to pay this much more for food or this much more for gas, I was listening to something the other day where they said basically, look, people just won't go to work. It's more expensive to fill the car up with gas than what I'm going to earn at work. Why go to work? Right? Other people are going to say, well, I've run out of money. I can't pay the rent. That's it. You're going to have a bunch of people not paying rent. You're going to have people. Then what's going to happen if certain companies can't get the loans anymore, or they're spending too much money paying off the loans, and they're not making enough money because there's not enough product coming through, and their prices are too high, and they've already shrunk their margins. Can't pay the staff. Staff just walks off.
Yep.
These are the type of things that we can be looking at, and these are the type of things we want to be prepared for.
Right.
And if they don't happen, great, fantastic.
Yeah.
I don't think it's going to change where the price of gold is headed.
No, not one bit. And this is inflation. These are all effects of that bad thing of inflation. It's a bad thing once it gets started. It just gets hotter and hotter and hotter until it gets cooled off. What that looks like with trillions of dollars in a debt crisis that we are in. We've been in a debt crisis since 2008. They continue to print more money to get us out of that crisis, bringing us to today. We are in the largest debt crisis ever in history. And there's one life raft. There's one life jacket, financially speaking, protecting you because there's zero counterparty risk. Gold and silver are stores of value beyond balance sheets, beyond currencies, and even beyond civilizations. What does Canada look like 5 years from now? These are conversations that I'm having with people who have pensions. And in 5, 15, 20 years, when you can actually tap into your pension, do you really want Canadian dollars? Will the Canadian dollar will be even around? If you have a $200,000 pension, and 15 years from now, what does $200,000 honestly get you in the future? Whereas you can load it up with gold and silver and have something tangible in your future that you can roll into. If the loonie's gone, you can convert that gold into whatever currency is on vogue in the future in Canada. But right now, anything denominated in a paper instrument that has inflated because of all of the stimulus, because of all of the low interest rate monetary, we loved it. It was great. But it comes to a point where it ends. And the party is coming to a crashing halt. I believe that this hard landing, and we're seeing countries have already pivoted. India's pivoted. Russia's pivoted.
In what sense?
Well, the sanctions with the Russian oil. India's like, no, we're gonna continue to import Russian oil. To no punishment. Did they reprimand India for doing that? No. Maybe got a little bad, a couple headlines, but beyond that, business will go on. People need their oil, people need their resources, and you got to feed your populations.
Yeah, I think what it's kind of ending up looking like is just yet another policy failure in the U.S., just another one in a string of policy failures of not being able to deal with things in a way that brings them to a conclusion, right? Like they're not even meeting in Ukraine. There's no talks. No talks.
Nothing.
And so we'll see how that happens. We'll see how it unfolds. But in terms of physical precious metals, this is all about. It's going to be, and it's already been, an incredible hedge. The difference is that gold hasn't caught up to these debts. They've kept up with inflation over the last 20 years. Same with silver, but they haven't done the incredible gains towards matching the debts that are out there, because it's hard to understand what those debts are and what they, in terms of value, right? Because they're just sitting on a balance sheet, but they don't matter right now. Eventually, they're really, really going to matter, and that's where he who owns the gold makes the rules. We're going to get into some technical forecasting, discuss investing in miners versus ownership in precious metals. But first, let's talk about the physical market, Jerry, what we're seeing in the physical market and what these shortages are really doing and how it's affecting everything. Let's start off with, how bad are the shortages?
At this point, Jeremy, I want to say there are shortages. I can't really say if it is. we're seeing really long delays on replenishing larger orders. So we do have product. Thankfully, we do have a variety. Delays on some product. We're noticing a lot of newer investors are coming in, so they're putting a lot of pressure on the smaller items. There is a notion that you need to have small items to barter and trade and to buy and sell bread. I don't really subscribe to that notion.
Me either.
But I understand the preparedness factor. We do have to become prepared, which I understand. So buy some maples, buy some 10-ounce bars, but then graduate towards the 100-ounce bars. So we're seeing some delays. Now, replenishment, I think it's about 6 weeks out on larger orders, and we're not getting from our wholesalers. Now, Paul deals with probably 4 of the largest wholesalers in the U.S., and sometimes there is no ETA. So that's a big alarm for us being brokers in precious metals. We have to give an idea, set expectations properly. But when you're dealing with a company that has been around and doing this for over 20 years now, Jeremy, you're coming to the right source. This is Guildhall. We've been doing this. This is all we do, inch wide, mile deep, precious metals all the way. We will deliver, but understand everyone's getting involved, and it's putting pressure on a finite market, a market, especially in silver, that we've seen over the past 7 years. The mines are not bringing out enough silver. So
yeah, the
whole chain is shot.
That's a whole other topic, getting into the miners. We should definitely jump into that.
Yeah.
I think that it's difficult because we're constantly buying. We're constantly buying new inventory and replenishing. The problem is you don't know when it's going to be received. So every day, every few days, we're receiving something, right? And it's hard to say, oh, we've got everything in stock. Sometimes we're completely out of things. And one of the things that I'm noticing happening now is, let's take kilo bars, for instance. We've got a large order of kilo bars of silver coming in any day now, and a lot of it's already been spoken for. Now, we don't typically like to sell and make customers wait. It's usually clients who've already have an established relationship who know us very well, so they're happy to say, yeah, order it, let me know when it comes in. But if you're a new client, I don't feel comfortable with it myself. I don't want to say, yeah, let's take some funds and we'll tell you when it comes in. That's not really a good way to go. So in that sense, it's good to just either put orders through the e-store or just contact us. If you have a sense of what you're looking to acquire, then we can put you on a wait list for that specific product when it comes in. Let's say it's 10-ounce silver bars. You can let us know how many you're looking for, and we'll let you know as soon as it comes in. Because even a large order of 10-ounce silver bars, for instance, we're not going to sell all of that, so that when it comes in, it's all spoken for, right? Mm-hmm. We're going to hold back some of that inventory for new customers. So give us a call. Let us know kind of what you're thinking. I love what you said, Jerry, the idea of starting small, then moving a bit bigger. I like the idea of crawl, walk, run. You want to know what this market's about. We have a lot of people who will call and say, so how does this work? What is this? And we're dealing in a physical asset. It's good to just get your feet wet, buy a couple 10-ounce bars if they're available, or a couple 1-ounce gold bars, which are definitely available, and just see what that pricing looks like, what it's like to get that physical product in your hand. And then we notice that people really move from there. They'll say, okay, great, I want to get more. Great, I want to do a TFSA. Oh, by the way, I have a Lira over at another company that I want to bring over. And oh, I want to do an RSP as well. And things can just build and progress from there. So I would say, in that sense, if anyone's looking for some advice, is not to think too far into the future. Just take it one kind of small step at a time, and over time it'll reveal itself of what will work for you moving forward in terms of your acquisitions.
Ultimately, yeah, it does come down to your preference. If you're okay with paying a little bit more for maples, you're going to buy maples all day long. But as far as strategy goes, right now would be the time to get started in precious metals. If you've been on the fence, if you've been thinking about it, if you've been watching and waiting, definitely now is the time. And just going to share some information from the foreign exchange blogger.
Okay, we'll get to that in just a moment. The number, 18778 Silver, the website, guildhallwealth.com. Remember, everything at Guildhall is physical. We have a motto: if you can't hold it, you don't own it. The best place to start is some small purchases. You can do that through the e-store at guildhallpreciousmetals.com, or you can contact us directly. We're happy to walk you through a purchase. We also have a storage facility. You can store the product at Brinks, at IDS of Canada. It's fully insured, underwritten by Lloyd's of London, outside the banking system, obviously secure, allows for liquidity, be able to buy and sell on a phone call. And then, of course, you can also own physical precious metals in a registered account, directly owned by you, unencumbered product, fully allocated, fully segregated, again, held in a Brinks facility outside the banking system. Great opportunity for people who have registered accounts. Jerry, let's talk about what they're saying in the Forex market and also looking at some of the technical forecasting.
Yeah, this is coming from Daily Forex. Chris Lewis, he's an analyst doing foreign exchange trading there. And his forecast on gold, the markets are breaking out of a recent consolidation. So a few weeks ago, we saw gold pierce right through the $2,000 level, touching just before its all-time highs. And then we saw a pullback, primarily because of geopolitical a breather from Russia and Ukraine. There were talks about maybe sitting down and having a peace deal, but that went by way of the dodo.
And on that note, it's kind of interesting, and I think it's good to point out that geopolitical events can spark a market, but they're not necessarily long-term drivers of the market, right? More so than, or less so than, inflation or supply demand.
Right. That would be sort of just a knee-jerk reaction. So we did see after the Russia hopes that there was a vicious pullback in the precious metals market, and it was actually oversold. The move was very drastic, and it wasn't a big surprise. The pullback was very quick though, and followed by a consolidation, and then now a move to the upside. Gold markets have rallied significantly during the last few trading sessions to break well above and hovering around the 1950 level. Christopher Lewis writes, there is really no reason whatsoever to short gold right now, which is a bet against gold. And basically from Thursday on was without a doubt, is a confirmation of that fact. So we're holding above the EMA, the 50-day moving averages, above 1900. Holding 1950. So we're likely going to be seeing 2000 once again, knowing that we have 50 basis point rate hikes coming up.
Inside of a month, Jerry, we went from, man, I hope we can break 1800 to, are we going to hold 1900, right? Big changes in the market.
Yeah, exactly. And the psychology is all because of the fear trade, he concludes, because as long as there's fear out there, there will be demand for gold and silver. Now, the fear has to do with geopolitics, inflation, Fed policy failures. Those are the fundamentals surrounding the fear factor. And it shouldn't be seen as fear for us in gold. If you have gold, you're positioned for some tremendous great times and some tremendous topside potential.
Yeah, if you're prepared, you're positioned, you're in great shape to weather any storm that comes your way. And when it comes to financial markets, there's so much in derivatives. There's 300 trillion in debt. All of these things could unwind very, very quickly. The Fed clearly doesn't really have a direction here. And in some ways, it looks like they're saying, well, whatever we do, it's going to fail. So I have a quick comment to make about that on the other side of the break. The number 18778-SILVER, the website guildhallwealth.com. It's The Real Money Show on AM 640. Welcome back to The Real Money Show. The number 18778-SILVER and the website guildhallwealth.com. If you want to get some smaller products or just test the market out for the first time, please visit guildhallpreciousmetals.com. That's our e-store. Great place to see the types of products that are out there, the types of costs in order to get into the market. It is a very competitive market, and if the product is available, that's probably the first priority. Jerry, just before break, I wanted to make a comment about the Fed. Just an observation, if you will. You know, when you control markets so much and you make yourself in control of every single facet of the market, in other words, you're buying, you're the bond buyer, not of last resort. You are the principal bond buyer. You are buying all the toxic assets. You are printing money and just throwing the liquidity into the market. You own it. Mm-hmm. You own it. You own every aspect of it. You've infiltrated every aspect of the market. There's no free hand. Right?
Correct.
You own it. You every single thing that happens in this market, is on you.
That's right.
So whatever the Fed does, it's on them. And it makes you wonder, well, are you doing it on purpose? I've asked this question for the last few weeks. Are they doing these things on purpose? Do they want to collapse the economy for some reason? Is this how they usher in the great I don't know. The fact is that if you have made yourself the entity in control of, you hold the marionette string of every single aspect of the market. No wonder everyone wonders what you're going to say. But when it's all at its end, it doesn't matter what button you push, what straw you put on the camel's back. It's on you. And it doesn't matter whether or not you did it on purpose, I think, because it's the end game.
Yeah.
There's no other. You just tip that chess piece over. Whether you raise rates, whether you print the money, it's over. It doesn't matter. It's over. The chess game's over. You've run out of moves. Yeah. Complete moves. The next thing is the currency being held all around the world, just as the IMF's secondary chief was saying that, look, people are going to sell their dollars. They're going to de-dollarize. They're going to say, well, why would I have this currency in this bank over here when you guys could cut me off? Right? And the CEO of BlackRock was saying, think that it's the end of globalism. This is it. The de-dollarization, end of globe. No one trusts each other anymore. Yeah. So it doesn't matter what button the Fed pushes. They own this. They created this. We just want to be out of the way. Okay? It's the Indiana Jones boulder. Yeah. And what are we going to do? We got to have some physical gold and silver. You want to be out of the way. You want to be out of the way of what is coming down the pike so that we're prepared for the next.
Yeah, exactly. And that getting out of the way.
Well, anything you disagree with there?
No, that's checkmate. When you have run out of moves, it is on the Fed. And the Fed has said everything, has done everything. They have run out of moves, and it's checkmate. We have to see which direction that chess piece is going to fall. But ultimately, it is right now about eliminating all counterparty risks. And this includes anything to do with any financial instruments, even companies that are exposed to inflation. We have to be very cognizant of that as well.
Is this the part in the show where you start talking cup and handle now?
I can, if you would like.
Okay, well, we did say we would talk about some technical forecasting. So what do you have on that note? Very quick.
Well, we have on the 1950 mark, as I mentioned before, so we should be looking up to the $2,000 gold level again. The yields keep dropping. The 30-year Treasury yield is keep dropping, and it's going to probably has peaked, and it's on its way down, indicating money is flowing out of risky assets into precious metals. So topside potential in gold will likely see a 2020, 2040, and break above 2070 perhaps. Silver, on the other hand, 25.50 up to 26.25, and then silver seems to be jumping about 25 cents for every leap. So be mindful of those pivots of 25 cents.
And the consensus seems to be silver breaks 30, we're going to 50. This time round, 30 is going to be just, we break that it as though it never existed, and we just take off.
That's correct.
Yeah. So let's talk about miners versus metals. Yeah. What's your opinion? I know you're not an advisor, but do you like miners? Are you against miners? How do you see them fitting? Is there a play there for people?
It does come up often. People are looking at gold, people are looking at physical silver, and they may speak to their advisor who may offer them, why not just get into a mining share, a mining company. We love miners. We hold some miners ourselves, but we see the mining and gold to be two different things. The Ibbotson Associates had a study about financial planners and what they should be offering their clients, and gold should be offered physically. It should be physical bullion because it eliminates counterparty risks, especially with mines, because with mines you have to eliminate things like accounting. Is the company beating the quarterly earnings expectations? And now we're coupling in inflation. Now, we know mining is a very resource-intensive business. Costs have gone up tremendously. The energy costs are now up about 50% year over year. So when you have that, falling on top of on a mining company, what does their balance sheet looks like?
Well, that just tells me that there's a floor to gold and silver prices, because if all of these prices are increasing, costs are increasing, then you have to it costs more to bring it out of the ground. That just puts a floor under the price of the metals.
That's right.
Yeah, I think what you're saying is that, look, you're dealing with a lot more on balance sheets and margins and management. There's a lot more to kind of negotiate there. And so the idea is to have the foundation in physical gold and silver, and then you can open it up to the miners, because ultimately there can be great gains in those markets. And from what we've seen, they're definitely incredibly undervalued.
Yeah, that too. I mean, while miners have some potential in them, but they have unlimited potential costs as well. The physical bullion, the metal itself, on the other hand, has never gone bankrupt as well. So we have to keep that in mind.
Well, Jerry, we've come to the end of another great episode of The Real Money Show. We've talked about Russia gold going back to some sort of standard, the end of the globalization as we know it, according to Larry Fink from BlackRock. We've covered some of the technical aspects. We've looked at inflation. We've kind of pictured what it could look like in terms of a fallout, and we even discussed the Fed out of options, checkmate. This is not going to end well. We have to have some physical gold and silver. Now, I know it's getting tough to get into the market. Be patient, one step at a time, get into the market. It's so important. The number 18778-SILVER, the website guildhallwealth.com. Thanks for joining, and we can't wait to speak to you next week here on The Real Money Show on AM 640.